The US dollar came back under pressure this week and was down across the board into Friday. But the price action has been somewhat perplexing. The yen stands out as the strongest of the developed currencies since the Monday open, with weekly gains already exceeding 3%. But the yen strength has been accompanied by outperformance in the S&P 500 and gold. While the broad-based US dollar weakness could reconcile the demand for all three assets, we find it interesting that it's two markets like gold and the yen that are outperforming along with the US equity market. It's true both gold and the yen are trading higher on the dollar selling as we stated, but it's still odd that these markets sit at the top of the pack in this scenario. We would be less perplexed if US equities were the top gainer on the week and the dollar was under pressure, with gold and the yen also up on the week, but underperforming relative to other currencies. And so all of this leaves a little unsettling feeling, and we're not entirely convinced we can read too much into the outperformance in US equities this week. There are clear signs of distress as reflected through gold and the yen, and we believe this is why these markets sit right behind US equities. These markets are absorbing flow from US dollar weakness and from distress within global markets. We would also caution against getting too bullish currencies against the US dollar right now and see a greater risk for a meaningful US dollar recovery. Now, we do see why the currency market has been wanting to extend the dollar weakness in 2018, with the falling trend line off the 2008 record high in euro dollar calling, and the case for that dollar recovery only really looking compelling until we can fill out that final little space right now that the euro is trying to fill so that it can hit that trend line and then have no excuses to need to keep pushing up. That trend line comes in around the mid 126s, and we're just a stone's throw away. Fundamentally, the dollar sell-off since Wednesday is equally perplexing, with the market completely dismissing the jump in US CPI, instead choosing to focus on the US deficit and soft dollar policy that will help to reduce that deficit. But we believe it will be very hard to effectively execute this strategy of weakening the dollar when US inflation is shooting up, the Fed is forced into a more aggressive policy normalization, and stocks are sinking because valuations are just no longer attractive. And so maybe we do see a little more dollar selling in the sessions ahead, and maybe stocks try to push up a little bit more. But it is the view of this desk that the risk of moves back the other way are very real and should be given more serious consideration. Looking at the Friday calendar, the highlight of the day comes in the form of UK retail sales, though we also get US import prices, US housing starts, US building permits, and Michigan sentiment. That's all for now.